Could new escalations in the Middle East cause a market crash? With oil prices surging and global tensions rising, investors are increasingly worried about the potential of a financial downturn. But what is the real risk here, and how should you react? In today's video, we will explore if this geopolitical turmoil could lead to a market crash. But more importantly, we will discuss how can you stay focused as a value investor, even in uncertain times. Stick around and find out how to stay focused and protect your portfolio. This past week, financial markets have been reacting sharply to escalating tensions in the Middle East. Oil prices have been surging, and while the S&P futures are holding steady for now, analysts are beginning to wonder, could continued tensions lead to a more significant market crash? We've seen market disruptions from geopolitical events before, but today we will take a deeper dive into what's driving the current volatility. We'll also discuss how value investors can stay level-headed when things seem chaotic. The core issue right now is rapid rise in oil prices. With fears of supply disruptions in the Middle East, energy markets have become volatile, and oil is the lifeblood of the global economy. So any threat to the supply can cause a ripple effect, driving costs up across industries. However, it's important to remember that despite the rise in oil prices, global energy production, especially in the US, has remained strong. This has helped to stabilize the market to some extent, preventing a total supply shock. But if the situation escalates, things could change quickly, and that is what's keeping investors on the edge. So, could these market tensions cause a full-blown market crash? Historically, geopolitical events like these often cause short-term market volatilities. However, they don't always translate into a full-blown market crash. For example, during the Iraq War in 2003, the S&P 500 initially dropped 14% as uncertainty gripped the global markets. However, once the situation stabilized, the market rebounded strongly, gaining over 26% by the end of the year. A more dramatic example comes from the global financial crisis in 2008. It wasn't caused by a war, but showed how markets can fall drastically in response to uncertainty. The S&P 500 dropped by more than 50% at its lowest point. Despite that, within 5 years, the index has doubled, recovering and growing beyond its pre-crisis levels. At this point, the markets aren't just fluctuating, they're already feeling the pressure. The real question is, will this lead to a deeper, more sustained downturn? If tensions continue to rise and other major economies get drawn in, we could easily face a broader sell-off, especially in sectors sensitive to rising oil prices. But here is the key takeaway. Even if the crash happens, that doesn't mean you should panic. As a value investor, your focus should always remain on the fundamentals. Short-term market moves are often caused by fear and emotions, not rational analysis. The best opportunities usually come during times of uncertainty. If stock prices fall, especially for companies with strong fundamentals, it could present you with a buying opportunity. Companies with healthy cash flow, solid management, and a competitive advantage may become undervalued. Instead of reasons to sell, times like these can be chances to invest. For example, think about the crisis of 2008. The markets were on a free fall and everyone was panicking. But those who stayed calm and bought undervalued companies during that period saw massive gains over the following years. It's just like Warren Buffett always says, be fearful when others are greedy and be greedy when others are fearful. So what should you be doing right now? First, don't make impulsive decisions. If the market dips due to rising tensions, that doesn't mean you should sell everything. Instead, keep a close eye on the fundamentals of the companies that you own. If they remain strong, it's likely that any price drops are short-term. Second, if you have cash on the sidelines, it might be time to start searching for bargains. Stocks that are unfairly punished during geopolitical events could offer great value if their underlying business remains strong. Finally, remember that markets tend to recover from geopolitical shocks. The uncertainty can cause temporary drops, but if you're investing for the long term, staying calm and making strategic decisions is key. So could these escalating tensions lead to a crash? It's possible, but it's not a reason to panic. As I always say, as a value investor, you should only focus on the fundamentals and not get swept up in short-term fear. Use these moments to find opportunities instead of running for the exits. What do you think? Are we on the brink of a market crash? Let me know in the comments below. And as always, thank you for watching. Thank you for sticking till the end. Please, if you enjoyed the video, consider clicking the subscribe button, and hopefully I'll see you in the next one. Bye.